Is gold more likely to go up or down? Current bias: bullish 65%, bearish correction risk 35%. This is the type of research I would personally use before placing a swing trade, combining technical analysis, macroeconomics, institutional positioning, supply-demand dynamics, and central bank activity. My highest probability scenario: gold is still in a long-term bull market. The most likely path is short-term, consolidation or pullback; medium-term, continuation higher; long-term, new highs remain possible, yet the Fed turns more dovish if political risks increase. One would prefer buying dips rather than chasing rallies. Macro picture: right now markets continue watching every inflation and employment release because they directly change expectations for Fed policy. Softer labor market data has recently supported gold prices by reducing expectations of tighter policy. Supply versus demand: mine supply, mine production changes slowly. Opening a new gold mine takes years. Supply cannot suddenly increase. That naturally supports prices over long periods. Are central banks still buying gold? Yes. This remains one of the strongest structural bullish factors. Recent surveys show 89% of central banks expect global official gold reserves to increase. A record 45% expect their own institutions to add gold over the next year. Although purchases eased from the extraordinary pace seen in 2022 to 2024, official buying is still historically strong, around 850 tons in 2025, according to the European Central Bank. Large buyers continue to diversify reserves away from heavy dependence on the US dollar. Examples include China, India, Poland, Turkey, Singapore. China's central bank has also continued adding to reserves in 2026, according to market reports. Smart money: institutional investors rarely buy tops. They usually sell into euphoria, buy panic. That means when retail becomes extremely bearish, institutions often accumulate. Biggest bullish drivers: central bank buying, global debt, reserve diversification. Geopolitical uncertainty, lower future real yields. My personal research conclusion: if I had to choose one side, I would still favor buying gold on weakness rather than selling strength. The reasoning is straightforward. Central banks continue to accumulate gold as a strategic reserve asset. Mine supply cannot expand quickly. Global debt and geopolitical uncertainty continue to support long-term demand. Even after periods of correction, many major institutions maintain a constructive long-term outlook for gold. That said, no trend moves in a straight line. Short-term corrections remain likely whenever US yields or the dollar strengthen, so waiting for a high-quality pullback entries generally offers a better risk-reward profile than chasing sharp rallies. This is my research and my idea only. This is not financial advice. Do your own research before take any risk, as the majority of traders and investors lose money. Again, it's just my idea, not financial advice.